Hi, and welcome back to my guide on the cash conversion cycle. Today we will talk about the day sales outstanding, which is another part of the cash conversion cycle. And we're getting closer and closer to getting the whole picture. So let's get started. So what does day sales outstanding actually mean? It's the number of days it takes to collect payments after it made a sale. And yeah, it's part of the conversion cycle, as I mentioned before. And you calculate it by taking the accounts receivable and divide it by the revenue times days. And again, we want to take the average amount of accounts receivable over the period we want to analyze. Yes, Alex, what's your question?
Well, the theory is good, but what about real-life examples? How do you actually interpret the whole thing?
Well, Alex, we'll dive directly into it. So if you have a lower DSO, that's better for your company because you manage your receivables much better, which means that less cash is trapped in receivables. So you have a nicer cash flow structure. On the other side, we have high DSO, which is not so good because in that case, you would have to wait a long time for your customers to pay. And the more you wait, the less cash flow comes into your company, which is typically a bad thing. When you compare two DSOs, you always have to keep in mind that you have to compare numbers or companies or company structures that are similar. So if you compare healthcare companies with consumer staples, it's going to be a bit difficult because they have different business structures. But just as an example, the healthcare average is 68 and the consumer staples DSO average is 40. So you can see that these different industries have different DSOs. And now let's get back into your favorite part, the Excel calculation. So bear with me. This is the Excel spreadsheet of happiness because afterwards you will know how to calculate DSO. So the calculation is fairly simple. You just have to take the average amount of this year and the prior year and divide it by 2. Divide it by 2. And you can just drag and drop the numbers over. Obviously we can't use the last number because, as you can see, we have no data for 2012. So this number is not really useful for us. And then we calculate the DSO itself, which is simply put the average accounts receivable of Apple divided by the revenue of Apple times the days we're looking at. And as we're looking into a whole financial year or fiscal year of Apple, it's going to be 365 days. So the DSO is 52, and we can again drag and drop it over, and we can see how DSO has evolved over time, that they had pretty low DSO a few years back, then it went up, and now they seem to have lower DSOs again. And yeah, that finishes off my guide on the DSO. I hope you had fun and see you next time.